have resulted in a stunning surge in US home refinancing. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome back Branko, who's been looking at some fascinating behavior in the US mortgage market and what that might mean for the rest of the economy going forward. How are you going today, Branko?
Good, Chris. Thanks for having me on. Keen to talk about today's topic for sure.
Thanks for coming on. Now, you had an interesting article today looking at factors that were not only really US based, even though the data was US based, but we're also starting to see some of them flow through here in Australia. But looking specifically at that US data, can you start us off by talking about what was it that really contributed to this surge that we saw in refinancing applications? Was it driven by the drop in mortgage rates or expectations of further drops from rate cuts, which we're expecting to see? Were there other factors involved? Tell us what was going on.
Yeah, so pretty much just to start off with the numbers. So you have this US refinancing index, which we'll put up on the screen. And pretty much over the past 2 weeks, we've had a whopping 55% increase in refinancing activity. And I mean, it's hit a 2-year high now. And it's quite a significant bump, even though it might look kind of small relative to previous increases. Given where we were, it's like extremely significant. And the reason for that is probably twofold. So the first one is, if you remember about 2 weeks ago, we did have that period where the US jobs report came out, and that was obviously quite negative on the economy. But just before that, we had the talk about interest rate decreases and their likelihood. And the Fed basically was saying that there was a big rate cut on the cards in September. And so people's expectations actually play a significant part. So, for example, they might go from a fixed to a variable rate with expectations that rates are going to start finally going down over there. And then the other reason is probably the opposite to that, which is in this cost of living crisis, a lot of people are struggling. And I actually know a couple of people, personally who are trying to refinance their homes just to get money to help out, with their day-to-day expenses, and obviously a lot of risks associated with that. So it is twofold. Generally it's seen as kind of an economic positive, but in this case, I think it's quite a mixed bag.
That's really interesting way of looking at it, because I agree with you. There's multiple reasons why people would be refinancing there, and it can be problematic if they're taking that additional money out or the additional time out, because it's not necessarily making it any cheaper. It's sort of pushing it further into the future if they're refinancing to extract money now from their home, using the home as a bit of a bank in some ways. So if they're doing that, is it really sustainable? Like, can they keep doing that into the future, or are they really front loading it in anticipation that things will get better in the future? How do you view the sustainability aspect of it all?
And it obviously relies on like the house prices to be strong and keep going up. And in Australia, I think you'd argue historically it's probably more of a sustainable strategy than the US, given how home prices have performed. Also, you are taking a bit of a bet on interest rates, which generally, given that, like right now, it looks quite positive over in the US, not as much here. But again, these things can be very unpredictable. So you are taking a risk there. So I would say overall, not a sustainable strategy, but more so in Australia compared to the US. And then also, you are taking significant cyclical and unpredictable risks with it as well.
Hmm. In the article, you mentioned that the overall cost of home ownership is still a lot higher than the average current mortgage cost. So what impact do you think that has or will have on future home purchasing behavior? Because when you particularly look at first time buyers, they're going to be looking very much at that sort of ratio or that relationship between the overall cost and what the mortgage is going to cost.
Yeah, there's an interesting graph that kind of compares this, and it's pretty evident that people are getting priced out of the housing market, significantly. And even more concerning that those that are in the housing market have a portion of them have started to actually refinance just to pay off, whatever bills they have. So
Mm.
um, it is very concerning, and I think it is obviously a negative outlook for people that are looking to come into the market, and especially the way it kind of significantly like increased over COVID is quite astounding. You look at the gap there; it's just like this unbelievable increase, and I think we did see that with during COVID with inflation, asset prices obviously significantly increased, and people got laid off, and wages kind of steadily decreased. So definitely a negative outlook, and as it relates to refinancing, um, you know, probably even more concerned that the homeowners are already in the market. A lot of them have had to refinance as well. So they're not in the best economic position themselves, given the interest rate increases.
Mm. No, that all sort of plays together. It's interesting that you mentioned in the article the Goldman Sachs forecast. And I feel like a lot of what you said so far is reliant, very heavily reliant
Yeah.
on these rate cuts that are expected to come. But I mean, you've effectively argued that they do influence both sort of the refinancing aspect of it and the housing market together. But is there a risk here that something, yeah, like this could all come unraveled if we don't get those cuts, or if the cuts aren't as big as expected, or they take longer to play out? I can imagine there's a lot of compounded impacts or compounded complications if those rate cuts don't come through as expected when so many people are refinancing on the assumption.
Yeah, I mean, I think it is concerning that, given this crazy increase around this time, that a portion of people probably relying on the fact that rates are expected to go down. A lot of banks in the US have already cut kind of their mortgage rates already in preparation for this. So it does all rely on these predictions. And Goldman Sachs in particular are predicting 325 basis point rate cuts just this year, and we're more than halfway through the year, and then four more next year. So I mean, it looks like they're in the US, they're predicting significant movement. In Australia, obviously, it's a very different story. I think we discussed that last week or 2 weeks ago, where we were quite behind in our kind of, I guess you would call it like a cycle. So we're still not really decreasing rates, and our homeowners are suffering. But it does all rely on these predictions being accurate. And to be fair, a lot of the banks are actually aligned over there in the US that it's kind of a similar outcome. So the odds are this would happen, but as we know, it is extremely unpredictable. I mean, all we need is some inflation report to be higher than expected, and then we're going to have another panic station situation, and it could cause chaos. So I guess overall, I'm surprised that people are kind of relying on these predictions so heavily. But if it does work out, then it will be the right decision for a lot of these people to refinance in this manner.
And that I think you hit the nail on the head. That is the real issue, the inflation aspect of it. Because if we see that surging back, that will be the thing that stops that party. I mean, we've seen in terms of unemployment, we've seen the weakness starting to show through there. That all the pieces are in place for the Fed to cut, which will ultimately flow through. Probably, we'll see the same thing here in Australia. But if we have that inflation tick back up again, that really is the nail in the coffin for that argument.
Yeah, I mean, it's amazing that just like 0.2% is just going to change so much. Like, if it's slightly above expectations, all this, it's going to be chaos. I mean, like, I mean, it's not like an overreaction, but it's almost it's priced in, the predictions are there that we're going to have a cut, and it is expected, so there is good news, and everyone's kind of positioning themselves, both banks with their predictions, and individuals are positioning themselves for it. But there is a risk, obviously, that it doesn't happen. So you've got to prepare for that as well.
And I'll probably wrap up on this point, because you've mentioned that about the banks, and if we focus in on them a little bit, you talked about some challenges mortgage lenders faced during that period of rising interest rates. And we know that we talked about that quite a bit, the challenges that banks were under. What is it that allowed some of them to survive? Are they at risk this time around? If for a similar set of strategies in the opposite direction, does it hurt banks when these rates fall? Because I would imagine that it's actually somewhat more challenging in a falling rate environment to be profitable as a bank.
Yeah, so I think a lot of the that's a good question, because in the higher rate environments that we saw, like I remember Combank came out, I think it would have been last year, and they had like their record profit quarter. So,
but it was also the time that we saw those, smaller banks in the US under massive pressure.
Yeah, so I think that it is very interesting how it's going to affect small versus large banks. Obviously, because large banks have more loans, they have more turnover. Rate movements are going to more positively affect them because they're going to add their margin on top and get a lot more. And I think these small banks, it's probably more important to have like a positive economy, a lot of economic activity, because a lot of small businesses go to them for their loans, right? Because they're probably more likely to get a business loan through a smaller bank than these big banks. So as far as how the lower rate environment, I think it's probably going to affect small banks positively because it's going to stimulate more economic activity, and they're going to get more loans that fall under their categories that kind of they profit more from, because obviously the spread on these riskier loans is higher.
Yep.
And I think as far as big banks goes, they're probably going to not profit as much because they won't be able to tack on those extra bits, but they'll still probably be very profitable as always.
No, that's a really interesting point, and I hadn't really properly thought that through, but it makes sense. It's really about who your customers are in those different environments, and in a falling rate environment, as long as that's not because the economy is falling off a cliff, that's probably very supportive for those small businesses who are trying to, expand. But then, I mean, we just have to wait and see, I suppose, to see what the economy actually looks like at the end of that process. But
yeah, that's a good caveat, that if like they're cutting rates because the economy is going to crap, then it's probably all banks probably will struggle. But if it's kind of stable and they're cutting rates as a part of what we're expecting and greater economic activity, then it's probably a good thing in general.
well, as always, really useful information there. Thank you, Branko, for your work on that today.
Thanks, Chris.
Thanks everyone for watching. We'll chat again soon.